Okay, let's start. Good morning. Good morning, everyone, if you're in North America or in South America, but good afternoon, everyone. It's a pleasure being here and with Debora once again. If there's a moment in which I think it's important to discuss issues is when we have big challenges ahead of us, and in particular for Europe, there are significant challenges, and one of the big challenges is exactly how to boost investment and growth in Europe. And I think there's very few institutions in Europe as the European Investment Bank that has dedicated so much over so long to this issue of how to boost investment in Europe. And Debora herself also has been working on these issues for a long time, in spurring also the survey that you have at the EIB for quite a few years. And I'm pleased to say that in this economic outlook of the OECD, which will be launched in a month's time, and you'll be in the panel discussing this, we have a specific chapter talking about investment. And in fact, we try to ask what are the causes of investment being so low. We look at business investment, we look at housing investment, and also public investment. All the parts of investment are coming down, all the components, but in particular, business investment has been significantly lower. And as a consequence, we try to dig what are the causes for that. I'm not going to talk about it now, but I'm very curious to see the latest results from Debora's team on this issue. Debora, as you've met Debora before, many of you in presentations here at the OECD, but also important to say that Debora holds a degree in economic and a master's degrees from Bocconi, and as well a PhD from the University of Ancona in Italy, and she's been adjunct professor in macroeconomics at Bocconi, and has been working as well at the EIB for a few years. So without further ado, Debora, it will be great if you give us your presentation and your take. How do you see the investment situation in Europe, and how do you see how can Europe boost growth and investment in the next few years?
Thank you. Thank you. And I think we'll move. Press. Okay. Thank you very much, and it's really a pleasure to be again here and have the opportunity to discuss about investment and investment dynamics in Europe and how we see the current challenge. And as Alvaro was saying, we have very nice collaborations since many years, and it's really a pleasure to be here. So what I'm going to present is actually a bit of a take from our flagship economic report that was published at the beginning of March, but of course the world is changing very fast. And because the world is changing very fast, I try to put everything in perspective on the challenge of today and what is happening. But there are a lot of questions, so there are answers in what I will say, but also a lot of questions. And I think as everybody from the policymaking point of view to the analyst point of view, I think we are all trying to understand what is happening at the global level. And I will have a bit more of a focus on Europe. I think Europe is very important for many reasons today, also because in the new global context and the reshaping of equilibriums at the global level, it's quite important the possibility and the capacity of Europe to really position as if you want a third block, powerful blocks. It's a unique opportunity for Europe, and I think at the European level we are very much discussing about how to deliver in this moment in time. But it's also a very important point at the global level with the, if you want, US, China, and the rest of the world, the readjustment, what will be the attractive power of Europe and the strength of Europe in the new equilibrium. So there is a... slides are okay. Okay, so that's the basic the report that that I'm going to speak about, but actually with some reflection going further. Also because this is a annual report, so we published and we started working on the new one. So that's the rolling. I think that you have the same in terms of analysis. So the starting point is we are. I think no questioning on this. We are in a new global context. There are very important structural shift and adjustment underway, and the underlying issue is widespread uncertainty, or if you want, even more unpredictability of the global context. And in this context, actually, Europe positions with these huge and widespread unpredictabilities, positions with a number of very important challenge to face. On the one side, the need to enhance security and defense capability and actually provide a new counterbalancing element at the global level in terms of autonomy in security and defense. There is the very strong challenge in terms of competitiveness that actually is not at all divided from the challenge of the moment. We have been talking a lot about European competitiveness, Draghi led a report in the last years, but in fact, security and defense competitiveness go hand in hand. And then all calls for accelerating investment in Europe. And accelerating investment in Europe in a moment in which uncertainty and unpredictabilities are the best enemy for investment overall. So the challenge, if you want, is how to keep this transformation going with accelerating investment, delivering on security and defense, delivering of European competitiveness in an environment of structural transformation and very strong uncertainty. Our policy message are, if you want, a big back to basic. So we try to look at what are the immediate things that we should take care of at the European level. The first one is something very much in the to-do list of you, at least at the European level now, and potentially also of member states. There is a very strong new accent of integration, simplification, and support to innovation or larger scale investment on the policy point of view, and I will detail it more later. But I think really that one of the unexploited potential, and possibly for many reasons, but at the European level, is really this simplification part and the further integration. And I will show a few data around that. There is a second point that I think we keep very much in the policy toolkit. There are, the way in which I put it is leverage on EU strengths, and in the European strengths there is green leadership and the social investment models. We all know that there are drawbacks related to green leadership. We all know the rule of China in some green technology. We all know the US kind of getting back on the principle of climate as a policy goal, but actually what we really think at the European level is it's in European interest to proceed with the net zero transition and actually leverage on the success achieved so far. It's for many reasons, Europe being an energy importer, and being an energy importer, the transformation of the energy sector is in our own interest. It's also because actually Europe is doing relatively okay in some green technologies, a market that is expanding, and Europe is taking pace. China is also very good, but Europe is also very good. And there are opportunities to get out of this. And on the social side as well, we think there is more to achieve through the social model in Europe and some kind of quick win to take it over. And then the last point on the policy toolkit. We come, and I go back before, we come from accelerating investment. So we need to continue to accelerate investment. We come from a long period of time in which actually policies to support investment have been very strong. Actually, a lot of policy support has gone on incentivizing private sector investment. And as Alvaro was saying, actually, private investment has been relatively disappointing. So we try to see what really works. So if we go in a world in which resources may be more constrained, knowing what works in terms of policy support to investment is important. And we have two messages that at the European level are quite telling. The first one is that policy support should be targeted. If Europe, but I suspect it's valid everywhere, if you have a clear policy objective, it's better to support with a objective tag the firms, so they will respond more to targeted incentives. And the second one is European, and I will explain a little bit later more. But I think on the policy point of view, having in mind that policy support to be effective really needs to be targeted, and if you want a single market in Europe, also being European design. So that's the key messages, and I think I hope that after the presentation you will recognize the importance of these policy points. I start from the macro side, and this is really a brief reflection of where we stand today. I think the level of uncertainty, and particularly policy uncertainty, is peaking, and it's at a level that we didn't see from the start of the millennium, actually. So what you see is really we are at top levels of policy uncertainty, more in the US than in Europe, but the levels are really, really high. So policy uncertainty, that's the message, is really something that is challenging for all economic agents in the economy. The second point is something that comes very clearly in the global policy agenda today, and it's trade balance in goods and services, where what we have is the extra EU trade of the EU, the balance with China and the US, one for goods, one for services. Why is it important? In the European thinking, that's not that much important, in the sense that Europe doesn't have this concept of current account balance. But I think it's very important to think that if one of the global trading powers has this as the basis of the policy framework, then it matters, because we will be facing policies at the global level that ask for a rebalancing of the current account and then trade and service balance. So what is happening on the trade side will be actually part of the policy framework that Europe will have to digest coming from the global level. And the fact that Europe has trade surplus, actually both in goods and the services, and if service side is correcting, I think that tells what is the environment that Europe will face. And then the third point is actually something new that we are experiencing, and it's a longer-term trend, actually, of Europe being perceived more as a safe haven in the financial markets. And that's something quite quite new, I think, at the European levels in terms of the reaction of financial market to the announcement of tariffs and the development in the last months. Actually, what we have seen is that in the moment in which the new trade tariff has been announced, actually the spread at the European level have been reacting less. There has been no reopening of spread within European countries, very, very marginal. So actually there is some perception that Europe is more of a safe haven in terms of financial risk. Can come for different reasons, but I think this process of opportunity for Europe, both to reposition in terms of financial market attractiveness and being perceived more of a safe asset, is something that is quite interesting opportunity going forward. I move to the investment side. So what do we see in terms of investment dynamics? So the first point is what I was mentioning at the beginning, basically that investment in Europe is coming from a period of very strong dynamics during the pandemic, energy shock, due to a lot of policy support. And then what we have started to see in 2024 is a correction, also very much related to the tightening cycle. But and then what you see is actually investment that has remained mostly supported by the government sector and very much related also to recovery and resilience facility deployment. On the right side, you see the rule of public investment and investment grants. Actually, the data take a long time to be released, but there is a lot of also of the recovery and resilience facility there. And what you see is really the very strong rule of what is investment grants. So it's a public support to the private sector for investment. And that's somehow it tells you something, assuming from many indicators, we know that it's the same thing. Knowing that investment grants remain strong, what you see is that in 2024, you still had a lot of weakening of the corporate investment part, despite a lot of public support. So looking in the long term, it's really how can you have stronger investment dynamic, public sector, private sector, if you don't have that much of the policy support coming up in terms of investment. And one thing that we did was actually to look at the long-term dynamics and to look at investment at the European level and look at a period of what we call a kind of investment acceleration. So a period in which the investment over GDP was actually higher for some period of time, a period in which there was some acceleration. And what we find out is something quite interesting. So there are a lot of up and downs, clearly, but period of acceleration mostly came at period of big structural shift, policy-induced, but a policy in terms of regulatory change that created business opportunities, and then the private sector was responding to the business opportunity. So the real period of acceleration are coming when you have a big market opening, big new opportunities, and then the private sector comes and invests. Can come a little bit earlier in the preparation and then in the period of ramp-up. Where do we see it? We see the EU single market. Actually, the whole period going to the single market is a big period of acceleration. The market is being creating a lot of business opportunity, a lot of investment coming in. There is something associated also to the euro area. There is the big enlargement to the east. And then there is a last phase. We tend to associate it to the all policy, first of all, coming from the very deep in investment, but there is an whole period of policies of economic transformation, focus on investment, and also the Green Deal and the Recovery and Resilience Facility. So it's a little bit a different period of time, the last one, but actually there is this idea that investment follows a structural shift that create a business opportunity. So the message is somehow today we also need this transformation. We need the business opportunity to come, the structural shift, the business opportunity and investment will come. And then something on this if you want the structural shift and business opportunities, I think that's the way in which we look at the simplification and the European integration point of view. On simplification, if you want, and this is something you have done a lot of research always on barriers to investment. We have our own survey that year after year tell us what are firms concerned of. There is a focus on uncertainty, energy cost. The energy market in Europe is something that we know it has to be to still evolve in order to deliver the full benefit for the European market, also in terms of competitiveness. The skill gap, so we know what the barriers are. Uncertainty is likely to stay and actually to be even stronger. The skill part is something that where policy focus is very much needed more and more in terms of effective solution at the European level. But then there are a few things that we were trying to quantify. Actually, using our survey, we ask firms what is the cost of salaries of staff that are fully focusing only on bureaucracy. And it comes out that it's some 2% of cost of salary of 2% of turnover for firms and 2.5% for small and medium enterprises at the European level. So these are people that are only dealing with bureaucratic issues that are employed by companies. The numbers, 2%, is it high or low? The energy bill for companies in Europe is 4%. So it's 2.5 is not bad. It's actually quite a cost for firms in terms of bureaucracy. The other point that we were asking actually firms if European firms export to another European country, do they face barriers in terms of access to the market? You can think at consumer protection standards, papers that have to be filled, VAT requirement, the labeling issues, etc. Actually, 60% of firms in Europe say yes. Consider that in a fully functioning single market, you should have a zero. But this is all the friction in the European single market that makes even intra-European trade difficult to perform. Why is it so important? I think it's extremely important for many reasons. Why? Because Europe cannot really benefit from the fully integrated market in terms of demand on the one side, and the market is fragmented and the full benefit is not there. Second, because the internal market can be a buffer, particularly in times of very strong global tensions. And again, you are not fully benefit from that. So the idea of doing more in terms of the single market and removing the internal barrier that still remain is something that at the European level is getting back on top of the policy agenda. There is the whole discussion on capital market union, where the narrative is changing in terms of talking about investment and saving union, where the real issue is how to move savings into financing and investment, and particularly the innovation finance investment, very much related to equity investment that we need more at the European level. And here, I think the challenge is really, on the one side, the fact that savings are very much cash and deposit based, so very conservative household saving behavior. In between, we have a small stock market that we know, but we also have a lower role played by pension funds or insurance corporates in reallocating toward equity investment. And what is interesting is while their activities in terms of equity investment is lower in general, it's also interesting to look at that pension funds, when they invest in equity, do it very much in the rest of the world. Very little the component that is done within Europe or domestically. Insurance have a different point. Actually, there is a very strong home bias of insurance when investing in equity toward the domestic market, and very little intra-European diversification. This in an integrated market should not really happen, because insurance companies should not have a bias in terms of where they invest in equity in the European market. But what is emerging is that there are some friction to the single market, also in terms of regulation on the insurance point of view. So there are issues also on that part of the system, pension funds and insurance, to have them investing more in equity, and investing more in equity cross-border within Europe, not only domestically. And the last point is what does it mean for firms? And that's something where we care a lot as an institution. We have seen that actually innovative companies, through their life in Europe, they have access to much less finance. They start having the same access to finance than in San Francisco, as an example, but as they grow, the access is really reduced. It takes much more time to get resources, and they actually get much less. After 10 years, European firms, innovative companies actually get 50% of the financing. And that's really a challenge coming as firms tend to grow. So we end up with this scale-up funding gap for European firms that, as I was saying, as an institution, we are trying to deal with. We are actually soon coming, our president is already pre-announcing on a plan on financing innovative companies, which will try to have a one-stop shop for innovative companies that wants financing through their phase of growth, and developing more instruments, particularly trying to accompany the scaling up companies on the one side, and on the other side, trying to develop more larger funds that operate cross-border at the European level, that have the potential of diversification in their investment. So really trying to create more of an ecosystem at the European level to support companies in their growth. And I think this is something, part of the policy answers that we are seeing coming at the European level. I was talking about what Europe can leverage on, and the strength in two aspects. And I think I will actually go quickly, but two things, and I know that it's, you can see the glass half full or half empty. There is a lot of discussion on what Europe is losing in terms of innovation. What we find out are two messages. On the green technology side, Europe is doing relatively okay. China is doing very well, so we know the excellence that is emerging. What is still interesting to see is that when you start looking at this concept of collaboration network in green technologies, actually it's one area where Europe is at the center of the collaboration network, and that's a good message. So not only Europe is relatively good in terms of innovation side, but collaboration rotate around Europe, so it's still a center of competence and knowledge on the green technology. The second part is something that we were trying actually to measure is the growth in export on green technologies, looking at a very granular level of the green technology export by European Union, China, and the US. What we see is, first of all, that's a export market that is very strong growing. China is growing well, so it's taking the business opportunity. Europe as well is actually growing very fast. US much less. So the message is there is one area where Europe, through strong policy ambition, has been developing, being better than in other sectors in terms of innovation, being at the center of collaboration network, is also catching the market opportunity. And we think that this is an area to leverage and continue to leverage going forward. It's important also on a policy point of view. I will just mention, I actually have it later, but no, I actually wanted to show this. Not all technologies are the same, of course, and here we all know that the prices are calculated in a different way, import prices, export, and production. But here at the European level, you see the different technologies. There are some areas in which, particularly solar, the technologies are really different. Solar, I think import of solar is really strong. Technology is relatively mature. I think we are getting to the point that at the European level, it may not be the most efficient strategy to try to do something to replace the import on the solar side. There are different thinking in terms of electric batteries. I think the traditional electric batteries may be a more mature technology, but we may have to look at the new evolution in terms of more support to the innovation and also to the production side. But actually what you see is actually that Europe, both on the production side and on the export side, in some technologies still maintaining edge. Much more has to be done. And I think what we were trying to look at is where are the markets, both for import and for export of Europe. And I think on the import side is really the very strong rule of China that we see. But also on the export side, I think Europe has a relatively diversified market for exporting on the green technology side. The last point on the net zero transition, and I think it's very important in this moment, particularly if there will be a backlash at the global level in terms of climate policy. One of the analyses that we are doing is looking at the effect of policy stringency and climate policy stringency on firms' return to investment in energy efficiency. And what we find out basically, and I skip the graph if you want, but the message is that when there is a high policy stringency, actually there is always a positive return for firms for investing in energy efficiency. When there is a low policy stringency, particularly the most endangered firms, the one in energy-intensive industry, actually the return of investment is non-significant and very low in any case. So the message is if you are weak on the policy stringency, actually the most endangered firms will have a very little incentive to transform. basically get bailed out. So if you really want to have a transformation of the industry, and particularly of the most endangered one, the most challenged one, you really need to have a policy incentive and a clear direction in terms of climate action movement. The last point that I wanted to mention in terms of what Europe can leverage on, and I focus mostly on the first one, on the first graph, we tried to look at what would be the effect in terms of EU GDP gain for matching participation rate of the top performing EU country in various areas. Women participation, men and women with low educated parents currently not at work, people with disabilities, etc. So this is just to say that there are upside in trying to use to attract in the workforce. Women participation is one of the examples through social policies. So, in fact, there are upside in terms of long-term growth, and I know that you do a lot of work on that aspect, so I don't focus that much. But in reality, the European social model on a global point of view is actually an example and opportunities to learn across countries. I come to the last point, and that's on the policy point of view, what we can do. And I think here are two messages. The first one is something that in the institution, in the EIB, we think it's quite important to remind. Actually, at the European level, we have been experiencing a lot instruments to catalyze private investment into policy goals. We actually have experience with multipliers that from the public money as a risk coverage factor with lending of institutions and then the co-financing with the private sector go to multiplier of 14 to 18. It's something for institutions like us is quite understandable how it works. Using more of this instrument, particularly in public budget and in a European budget, is something we think on the policy point of view can be done more. Not everything can be financed in this way, but actually you can have more leverage and outreach and catalyze more private investment into the policy objective through financial instruments. And the last message is what I was saying at the beginning. So this comes from two analytical projects that we have in our report. The first one, we look at firms that receive policy support. So we have this database of firms in Europe, and we know which firms receive either grants or finance in concessional term, you can say, or a very low interest rate and long maturities. What we see is that actually the firms that receive the policy support, they actually react much more when the support is targeted. So if you have a policy tag attached to it, you give the support for energy efficiency, you give the support for green technology investment, you give the support for something quite clearly defined, and you control it. In that case, firms react. Otherwise, you don't have much of the effect. And that's quite important because in the design of policies and instruments, having the precise tag and verifying for what firms were supposed to use the support actually is important for the effect that you will have. The second one, and is something, again, quite European, we basically observe that whenever you have a public intervention supporting a company, you distort the market, you distort a bit competition in the market. But what we find out is basically that if you do it at the European level rather than at the national level, the distortion effect is minimized. And actually you have less distortion of the market by providing a support widely at the European level rather than at the national level. The effect of reduced distortion, if you want, is larger in mid-tech sectors, and that comes because in mid-tech sector at the national level is where national intervention tend to be more, if you want, distortionary as well. So go less in terms of strong economic rationale. So at the end, what we come out saying is if we need to support private sector for delivering on certain policy objective, it's important that the instruments are designed specifically targeting objective and checking that it goes in that direction, and then that it's done at the European level because it provides less distortion to the European single market. Saying that, my closing point, I think I go back to the original slide. We are in time of structural shift and widespread uncertainty. Europe needs investment for security and defense, for competitiveness. And in terms of policies, I think the initial point of simplification, extremely important, leveraging the integration of the market, the upside that is still not exploited, leveraging on the green leadership that is still there and the capacity of the social investment part. But the last point is also important. When policy intervention is designed, it should be more European level and more targeted. And with that, I close and thank you very much.
Thank you very much, Deborah. I can, well, if you have questions, please raise your hand, either virtually or in the room. I can start. Well, we have one already there, a few there. We can start with, I would like to start with a small one, so that, which is basically, you were saying that the pension funds don't invest enough in Europe, right? And of course, we have a lot of European, well, a few pension funds. But isn't that just a reflection that there is not enough returns or not enough opportunities in Europe? So you picture Europe as fairly positive, probably more positive than we are right now here at the OECD. But isn't this just a reflection that we should be, perhaps investors don't see Europe so positively going forward?
I think so. There is not a, no, I fully agree in the sense, and actually we had a very nice panel discussion here at the OECD a few months ago, actually. Yes, exactly on the point. I think there are, it's a chicken and egg issue, so both things are there. What I find strange, I think, of course, if you have to invest for the long term, you need also to look at the return of investment, and the US market that are much more developed are actually offering more opportunity and a more stable return. What I find striking is the fact that particularly on the insurance side, there is a very strong bias domestically. Yes, that's lower volumes, but why such a bias while the diversification within the Europe should give you also more opportunity of a more stable? So I think there is a little bit of, you need a more developed market that offer more opportunity for investment for pension funds, and then they will go also more at the European level. At the European level, the diversification of investment, when insurance decide to invest in equity, they don't catch the diversification potential of the European market, and that's a regulatory base in some cases, a very soft thing. I heard about one country where the reporting requirement is much less complicated if they can invest in the domestic market. So it ends up with a small effect that actually are distortionary in terms of investment. So it's a bit of both, but I think Europe thinking how to reinforce the international role of Europe, of the euro, now could be a moment. Also coming from what I was saying at the very beginning. So maybe we are in a phase in which it starts that the dominance of the dollar will slowly, hopefully very, very slowly decline, and there are new opportunities for new currency and new safe asset. But it's hopefully a very, very slow process.
Yes, I will give you the. No, thanks, Debora, for coming here, and it's a pleasure to see and thank ECO for organizing that. As you know, I'm in charge of the cross-border investment. I'm focused on the cross-border, and it's very interesting your presentation. But I have two questions for you. One is more about European is not very well integrated at the investment side. You know that in a way you are dealing here and you're presenting this issue that like as we have one Europe, and even in terms of the delegates, I can tell you because we have OECD Investment Promotion Agencies network. Each one is trying to attract to their countries. We have FDI screening expert, and then now they are coordinating a little at the EU level. But I know even investment treaty negotiators right now is under the EU, but still not completely with some issues there. And I think that this is not like the trade that is much more integrated at the EU, even in some regulations, still there are work to do, but not. That means that how you are dealing with this part in your policy advice, because there are a lot of things that at the institutional level, the integration of the Europe as and the investment and the finance side. And the second issue that is more related with this kind of what you said about the structural, the issue that the Green Deal, for example, attract more investment, and this structural change attract more investment. But and then at the end you said, yeah, if we have European instruments are less distorted, okay, than national instruments. But on the other hand, we are living in a world that if each one start to do this kind of stuff, and it started before Trump, like in a way, then we have a real distorted world. And we work a lot with non-OECD countries too, because we want to investment to flows, and the spillover of these kind of measures are being very strong. I mean, and also want your opinion on this kind of stuff. Thanks.
I answer, okay. So on cross-border investment, so two things. On the one side, Europe would need much more, even within Europe, cross-border investment projects. That is something actually I was hinting at the energy market, etc. I think Europe in a few sectors really has to come out with even more defined strategies of cross-border projects. Somehow it has worked up to a certain point so far. One of the elements, even the Recovery and Resilience Facility program that brought a lot of resources and money also for public investment in certain areas, was not delivering that well in terms of the cross-border projects. I think very little was done, because when you give the incentive at the national level, and then you need to coordinate with another countries, is much more difficult. So I think that at the European level, we are trying to think how best to deliver in these cross-border projects. That is on cross-border project per se. Then when you talk about promotion of investment abroad, that was part of the same question. I think this is something that we are currently actually thinking and discussing. Actually, whether at the European level there should be some more support, not only on export credit support, trade facilitation, etc., but also on investment promotion abroad at the European level. As you were saying, now it's very much domestic based, and very much depending also on the fiscal capacity of different countries, etc. So we are trying to think if European, there is some kind of instrument that you can put that put different countries within Europe at the same level in terms of supporting, promoting investment abroad. I'm thinking of companies, European companies participating in tenders or international projects, etc. So to put countries in the same, but it's a very, very early thinking, and it's coming, if you want more on the reflection, if you are in a world of massive uncertainty, the complexity for firms to operate is higher, so you may want to reduce some of this uncertainty with some policy support, guarantees, or something. So that is something coming, and actually would be really interesting to discuss later. The second part, I forgot already. Yeah, okay.
First of all, thank you, Debora, for a very interesting presentation, for sharing your views. I'm from the Economics department, and I have 3 short questions. First one, you talked about the importance of the capital market union, and it's an argument we often hear, as a way to spur more investment. At the same time, we're seeing that there are a lot of companies that are very profitable, that are having cash, that are buying back shares, that are paying out dividends, suggesting that maybe financial constraints are not the key factor, and that maybe it might not be the only problem. So how do you see these two phenomena connecting? Second, also on financing, we had another talk a few weeks ago here, similar, and there the view was shared that Europe may actually benefit from what's going on in the US right now with, say, less or more unpredictable policies that may drive especially big institutional investors to maybe, don't want to say turn their back on the US, but maybe, look more into Europe as a place where, policies are more predictable and where, therefore, it's more attractive to invest. Do you share this view? You hinted a little bit at that, when you talked about the dollar and the importance of the dollar. So how do you see that? Would you share that view? And then lastly, on the green investment, you argued that, this is one of Europe's strengths, right? And we should really focus, on the green part. At the same time, we know, European countries there were always some countries that were keener on the green transformation and others that are less keen, right? And now with the US, being less keen or, on climate change, not really seeing that as a viable target, to what extent do you think that maybe, European countries may become more divided? And to what extent may also say the increased focus on on defense spending in the light of scarce resources may mean that some governments focus now more on defense at the expense of investment in the green transition, because they need to decide what to put the money on. Thank you.
Okay, so 3 very, very interesting points. I start from the last one, actually on, I think it's, it's one, the reason why I put so much pressure on the net zero transition, and it's in the interest of Europe. I think we are in a moment in which there may be a weakening of the incentive, and I think it's very important to say that Europe is different from other parts of the world because we are energy importers, and we had a clear case in which we show all our vulnerabilities in the global context. So energy security in Europe means also developing renewable, other forms of stable energy, and investing massively in the grid to make sure that we have a system, an energy market, an energy system, if you want, that is guarantees security, and it will also be good for competitiveness. So I think the narrative may be going back to what is in European interest. And I think in European interest, part of what was the agenda of the net zero transition, that is invest in renewable, invest in energy efficiency, etc. You can also reread it, is in our interest, energy security means continue to what we were doing in terms of the net zero transition. And I think that is something quite important to rebring back in the narrative. So you may convince more of those that were more skeptic on the net zero transition just with the security and the competitiveness effect of a fast transition of our energy market. And that's possibly something that we may see more going forward. And I think that's something to rethink also in terms of the policy narrative in some countries. This is one point on the will Europe gain with the, if you want, with a potential decline of the international rule of the dollar, and can Europe gain out of it? We think there is an opportunity, and actually we are looking in ways in which you may see the opportunity. I make a simple example, actually, that is coming from our own institution, from our finance department issuing bonds. The EIB is a European bond, if you want. Actually, our issuance is going fantastically with like a 13-time oversubscription. And even when we issue in dollar, it happened recently, we issued in dollar basically at the level of the US bonds. So basically the spread is so compressed because in this moment, European risk is perceived better than US risk. It may be a temporary thing, so I think Europe is, it will, so to really strengthen the international rule of the euro, you would need capital market to develop more. So there is a long process to really take over, but at the margin, I think there will be some opportunities for Europe to catch. And actually, part of the policy agenda is going in this direction with many initiatives, starting for different reasons. More on the payment system, the digital Europe will come, etc. Try to have backing a stronger rule of the Europe and of Euro. And I think you already see this, perceive Europe a little bit safer in terms of the policy agenda. The other point that for Europe is quite important in this moment is on the trade side, the trade and investment side. And I think what is happening is more focus at the European level, also on building trade agreements and re-advancing on the developing of trade agreement to try to be also on the trade point of view more attractive for countries that maybe felt out of the global development at the moment. Then on the financing, financial constraints are not the main impediment to investment. What you were mentioning at the beginning, I tend to agree. We have also discussions within the team how much, but actually I think the main constraint is always, as I was saying, actually, the firms are telling us is uncertainty the biggest impediment. It's energy cost, skill, etc. Finance is coming much below, but there may be instruments and specific kind of firms that are differently affected, and particularly on innovation finance is one. But I fully agree. And what we find, and I think it's interesting, is that what you have is always. I find it quite interesting the work we are doing on the effect of policy support to firms. That actually the fact that it actually, in some cases, it helps the firms to reduce friction, etc., and to deliver on certain policy objective. That is something interesting, but it has to be targeted, as I was saying.
Thank you. Jens Låsgaard, Science Technology Innovation Directorate. You have been taking us through the high prices of energy that are holding back investments. You've been showing us how pension money are invested abroad. I'm wondering, we know that the price of new solar and wind capacity is delivering energy at a considerably lower price than the average prices we have in Europe. Is there a way we could get private money, pension money not least, into boosting our energy supply of new renewable capacity? And what do you do at EIB possibly to help along that financial market development?
So there are there are different elements. So you are mentioning the solar element. One of the thing that we were looking at, and also not only on the research side, but also institutional at the institutional level and European level in terms of policy, was whether Europe needs to produce its solar panel, if you want. After a long discussion also at the European level, I think we are now all agreeing that it will not be beneficial to the net zero transition to produce a solar panel that cost 10 times more in Europe rather than importing them. So there may be some areas of solar panel that some new technology, etc., that we may want to produce here. But I think on the production side, we have got to the point that we recognize that there are standardized, if you want, technologies where the upside of really investing to have our own production maybe is not that much there. But then there is the other point on deployment of resources. I think there we have been looking at what is delaying the deployment of renewable in Europe. I think there is a lot of, so everything already in the last years, a lot of simplification took place in terms of the authorization, etc. And that part is one part. On the other side, there is the effectiveness of the system and also the constraint related to investment in the grid. That is still one of the elements that is impeding a faster deployment. Renewable deployment is going very well in Europe, so it's a very a lot is happening, etc. But there are constraints that are not only finance related that block the system. And I think the one on the grid is where Europe really should start investing much strongly at the European level now. Then on the financing side, I think as an institution, we are actually one mechanism to finance a lot of renewable projects. So we issue bonds and we finance a project on renewable quite widely, both in Europe and out of Europe. So I think there is a lot of potential also with our own mechanism, but also to have other investors coming in. I made a longer story, which is because the final point, I think, is not only finance the constraint. I think there is a lot of constraints that is the grid constraint, etc. Those are also factors that slow the transition of the system.
No question?
Can I? Is someone else?
Yeah, okay, you go ahead.
Can I go ahead? Okay, thank you. Sorry, I wasn't unsure whether it was me. Ruben Maximiano, nice to be here and to hear you and see you, Debora, again. Really interesting presentation and very interesting Q&A as well. And I wanted to focus on that last part. I had two questions, but maybe I'll focus only on one, which is on the energy side of things. Because you mentioned that it's not just a financing issue, it's also, there's other issues. And actually we're doing work on that here in the economics department, precisely on the regulatory barriers. And it's something that will be coming out sometime soon. And there's a number of issues there. That grid is one of them. And of course, there's a whole host of regulatory barriers related to grid investment that exist. But there's also a lot of regulatory barriers related to innovation and new business models, because it's not just new grids, you need flexible solutions, flexible services, and you didn't need those before. So the question then is, to what extent a regulatory environment prepared for this new sort of business model? And you mentioned that some simplification has been done. I would say that's been done at European level, much less at national level. And that was my question now, is to what extent the EIB is involved in actually transforming the directives and the general guidance that the European Commission has issued into concrete changes on the ground. Because what we are seeing from the work that we've been doing, that I just cited, is that in many instances, many countries have not adapted their frameworks to allow these new business models, to allow these new innovative technologies like agri-solar and things like this. So wondering if you can enlighten us on work that you may be doing on this.
No, I fully agree with you in the sense that the going down from the European directive to the national level, there is still a lot of delays, and I think that is one area in which actually we would really need to speed up the simplification that is needed for the transformation of the energy market. And I think that's definitely something quite important also because there are, as you are saying, new business models to be developed. We are trying to look at few financing schemes on, the name doesn't come to my mind, purchasing power agreements, how to finance for the private sector to be able, so how to de-risk the system in order to guarantee the stability of demand for project, etc. So we are trying to also as an institution to use a new mechanism actually to try to accelerate some of the transformation of the market and making the renewable deployment more less risky and more attractive actually. But it's an evolving process, and actually we are as an institution we are looking a lot at it, and we are trying to see how actually the risking mechanism can be studied in order to have more deployment. But it's super complex, and you're studying so on this is super complex, I think. Also because we also as an institution are providing the financing, we are providing the technical assistance in many cases for projects, but we are not changing the regulations. So you can advise on the regulatory point of view. You can say, if this is the regulation, we cannot operate, but you don't change the regulation. So that's a bit the tricky part also as a financial institution like we are. But it would be really nice actually to connect also you with the operational people on our side that are trying to develop new projects.
Thank you. Sorry. Yeah, thanks a lot. I'm actually going to ask a non-European question. I'm the ambassador of Colombia. I mean, your presentation was, I think, was great. But also, one thing I like is that it was pretty much aligned with the spirit of the Draghi report. But then I must confess I had a cyclical reaction when I read the Draghi report. At first I was cheering, okay, finally somebody is saying what needs to be said. Then for a very brief moment as a Latin American, I thought, oh my God, but then that means that Europe will not have resources to invest in Latin America. But then I picked up again and I thought, oh, come on, hold on, it's not non-zero. I mean, in fact, investment is the one area we don't need to be mercantilists at all. So there is room for European investment to actually crowd in more investment in Latin America and so on. And then for a lot of reasons that I'm not going to go into, I think it's vital for both regions to have at the same time more investment. And there's a lot of opportunities for Europe to invest in Latin America. Actually, going back to the question that was floating in the room of whether it's a lack of opportunities for investment in Europe, clearly that's not the case in Latin America. There is, if anything, there is one place where really the constraint is capital, is not lack of assets or opportunities. And right now, I would be remiss if I didn't point out that there's this upcoming summit of EU Select that Colombia happens to be presiding. And one of the questions there is, how can we create investment policies across the Atlantic that enter in resonance, so that basically the investments in Latin America create more opportunities for Europe and vice versa. So there are lots of ideas floating around that. Recently, for example, of course, energy is a no-brainer. Then there are questions on pharmaceuticals, for example, creating kind of developing joint technologies. Even I heard an official from the European Union talk about defense. Okay, like maybe Europe is open to have parts of its European defense system being sourced out to Latin America, which I thought was great because it's good for technology transfer. So I just wanted to pick up your thoughts on that. Like how do you envision this joint venture, so to speak, between Europe and Latin America?
So there is actually a lot of talk in this moment at the European level, exactly on the point with a lot of reshaping of a global equilibrium and a strengthening of the international rule of Europe, with trade flow and investment flow redirecting, etc. What rule will Europe have? And in which areas there are unexploited opportunities that can be reinforced. And there is a lot of talking exactly on what you are saying. Latin American is the new opportunity, if the Mercosur agreement is there, etc., and what will be the opportunity. I think there is, it's still in the designing phase, and but the meeting you were mentioning is something everybody is looking at in terms of how to reinforce the collaboration, find win-win options for Europe and for partner countries. And it's really, we hope that European policies will go in that direction.
Thank you very much for the talk. I'm from the Economics Department, and we found your survey very useful in our own work on investment. I just wanted to pick up on something you showed at the beginning, which is the boost from public investment supporting total investment, and wondered if you'd done any analysis of crowding in versus crowding out effects, especially given the fact that we expect even larger boost to public investment in certain EU countries going forward. How can countries maximize potential crowding in versus crowding out effects?
So I think that will be actually still one of the topics that we are trying to investigate year after year. And we have a few projects actually on how public sector investment in certain areas is actually stimulating a private sector investment in the same areas. So we have a number of studies at the regional level. One on, I have to remember because it was a couple of years ago, one on regional public investment in R&D actually, that supports, so you have the public investment at the regional with EU structural funds at the regional level in R&D, and you actually have an effect, delayed effect of transferring to the private sector in terms of stronger effect in R&D for firms. And we had it on R&D investment, and I don't remember anymore, but we have a few studies where we try to see what is the effect of the transformation on the public investment side at the local level, and then the stimulus that you have on the private sector. And there are some good examples emerging. There is a lot of possibility actually of crowding out, but there is also some accompanying effect on creating the business environment that then is stimulating to investment. I think the balance is thin, but I'm happy, I really don't remember, but I'm happy to point you to the analytical work that was done. Maybe, Emily, you remember? No?
I'll ask you a question now regarding, it's not related to your report, but it's related to Europe. Europe continues to miss the boat in terms of technology, right? And he missed the computer, missed the internet, and now he's missing the AI. In fact, he's really behind the AI GPT or the revolution, you want to call it, because you look at patents, you look at all the R&D, China and the United States by far ahead of Europe. Then you have Europe like with 8.5% or less in terms of patents, or even less, together with Japan. So Europe is nowhere to be seen regarding the AI revolution. Europe is doing better in terms of aging because it's aging faster, but the big trends really, in terms of technology using Europe continues to miss the boat. Why is that so? And what can Europe do to reverse the technological relatively decline compared to others in the past few decades?
That is, that's the easy question of the day. I think, so I tell you, what I'm worried of, what I'm worried for Europe is really the very strong dependency that Europe has accumulated in terms of digital and also, if you want, on AI in the development of language, etc. So the big technology dependency, and that's I think it's something quite scary for Europe, where Europe has to see what are the alternatives. There is one area where if you wanted to be good on Europe, and it's a part of the future work that we are doing, there may be some opportunity, and that is on the industrial application of AI. And the reason why the industrial application may be different, first of all, you probably don't see it in patents, because most of the industrial application would just be considered as know-how, and will affect the firms, but you will not see in the patent side. And I think on that part, Europe seems to be quite good.
Can I just add something?
Yeah.
If I can just add something, sorry to interrupt.
But there is the huge dependency.
No doubt.
Yeah.
We had in our economic outlook, the chapter talks about intangible versus tangible capitals. And look at the intangibles, the growth of intangibles in the United States and Europe, it's just striking, right? So there's a graph that we have that we launch when we launch the economic outlook. I strongly suggest that you look at the graph, not you, but everybody. And it shows exactly that intangible investment is skyrocketing in the United States. In Europe is basically not flatlining, but not going almost anywhere. And this is an indication that besides patents and anything else, Europe is not investing where it should be investing. And the question is why? That's why I was asking you whether you have any good suggestion.
I think the innovation side is always, in the particular, but no, I think the whole issue of the innovation side is in Europe is what we are studying, everybody, since decades on how to strengthen. There is the financing side, there is the equity financing side on the innovation, etc., the startup, the scale up, the whole issues in terms of the innovation financing. There is the rigidity of the system, in many cases disruptive, resisting the disruptive innovation. And all of this is coming up. I think on the AI in particular, on the AI in particular, maybe, and that's what we are trying, but it's the future work. Maybe we can discuss more next year. We think there is this niche part. It's not the solution, because I'm super scared on the technology dependency of Europe, and even more scared after the events of the last months, in which in some cases you see that the service is not guaranteed for sure. But I think on the niche part of the potential of adoption of AI in the manufacturing sector, etc., I think there Europe could have is a small niche, but can have an opportunity.
Sounds good. Looking forward. We just came out with a paper for the G7 comparing productivity impact of AI on G7 countries. And the United States is up here, Canada is a bit here, UK is a bit here, and then Germany much lower, France and Italy way lower, and Japan as well. And this is all because of adoption of AI and exposure of AI and infrastructure, and we don't think that Europe is there. So Europe has a big...
But that is on the return of AI
It's
adoption.
productivity impact. It's the productivity impact of AI. So the diffusion of AI is happening much slower all across sectors of the European Union, so it's significant issues.
Okay. I don't want to talk too much about it because it's a super preliminary work, but actually we don't have such a bad impact at the firm level for Europe versus the US. So if you check a sector and firm level, actually Europe is not bad, but we have to cooperate on that.
Good. More questions? You have somebody in the chat? Okay. Can you read it? Or
To incentivize firms to engage in their ecological transition, is it possible for an EU member state to decide to systematically condition its subventions to firms based on ecological transition criteria? For instance, a decrease of the firm's GHG emissions by X percentage by 2030, and if not reached, the firm would have to pay back to the state.
I actually, so I think on the, I'm thinking, I've not seen it as a policy proposal at the moment, so I would not know if it's possible or not possible. I think policy-wise, I think we are going into simplification actually of requirement, etc. So I wouldn't see it as something coming immediately.
more questions? Anybody from the investment people that are writing in the Economic Outlook? Any question? Well, you have John, but... Okay. Oh, go ahead, Ben.
Much. I just want to follow up on John's very good question before about crowding in private investment using public investment. And you talked a little, I mean, you alluded a little bit to some of the sectoral kind of aspects. But are there, and you talked about financial instruments that can be used to crowd in private investment, but are there, has the EIB done any work on particular design features of these financial instruments which mean that they're more likely to crowd in private investment? So one could think of something like matching grants, for example, whereby you require firms to match the public investment, or different sort of design features in that sort of ilk. Is there any work that's been done that would allow us to say something about the design of these policies that might make crowding in more likely?
I'm thinking. So what we are doing, and maybe then you could talk with Emily sitting there. What we are doing actually quite a lot at our level is looking at the effect of EIB instruments to support investment, and so we read it in a different way. So we look at the multiplier effect, and different kind of instrument deliver different multiplier effect. So indirectly, you have one way is to look at the multiplier effect. So that is one of the elements of the, if you want, indirectly, you see the crowding in of resources. And according to the risk-taking part of the public the public support part, you would have a different multiplier effect. In terms of the design, most of our instruments actually they have the matching in effect that you are indicating, particularly when we operate with financial sector intermediaries. We always would ask the a co-financing part that is equal to what we support. So you would always have this matching element. And the last point, but that is not on our own data, but it's on the work that I was mentioning before, actually, in our survey. We see a strong effect of having the policy tag, if you want, on the investment, on the policy support. So if you give money to the firm without telling what they have to do, you are not sure to see an effect in terms of investment. Maybe the firm is better, but you don't see the policy effect. While we were trying in different sectors to see if you have a policy tag to the policy support, and you have different multipliers on sectors. So that is probably the analysis that is closer to what you have in mind. So trying to look at different policy objective, when you have a policy tag on the incentive you give to the firm, and you see the effect on the firm, on their investment. But that is a work that we are planning to do more and more this year. So it's really, we are coming up with the analysis, and it's exactly the work program that we are planning for next year. So it would be really interesting to share.
And sorry, if I could just have a follow-up on that, Catherine from the Economics Department. What is your sense of the additionality of that investment spending? Because basically, there's a push now for countries to try and provide depreciation allowances, support for sector or policy objectives that are also being penalized in the sense that costs in those areas might be increasing. So it makes sense for you to undertake the investment anyway. So I guess I'm asking how important is providing the additional monetary support relative to regulatory things, and how sure are we that we're just not recording firms that would have been increasing their investments anyway?
I think that's the big policy questions that we always have. I think we come, and that's kind of, I take it a bit more on a philosophical point of view, longer perspective. I think we come in the last year from a lot of policy intervention. So there is a lot of, and I was showing it before, the public sector support to the private sector for investment has been really, really at high level. So there is a kind of a natural dependency on policy support, on private investment from policy support. So getting used to, and a lot of requests coming. That's why on our side we try to really show the importance of targeted intervention, instruments that really tackle the market failure in specific sector, in specific areas, and really more going targeted in terms of measure. And that's what we are trying to pass also as a message. And we do it also operationally as an institution. So we would always operate in areas where there are market failures with instruments that really try to tackle the element, the constraining element. It's true that a lot of time the constraining element is regulatory. So that's, but that's you play with. In many cases, just a regulatory change would be the easiest, I think, for implementing a certain measure. If you think at I think as economists, we always say carbon prices will make the net zero transition.
There's time for one last question, but I did have a second one, which was on the state support, and there was a question was asked on conditionality, but that's not the question I want to ask. I thought the graphs were very interesting, where you showed the effectiveness of state support and basically arguing that actually European support directly seems to be more effective. Now, I was wondering whether you had any reasons for why that could be. I could venture perhaps two. One is the design of state support decisions. So the European Commission in state aid basically agrees but doesn't design. And so that's one possibility. And whether there was, and the other possibility, I can't remember what the other possibility was, but that seemed to be, for me, one reason. The question being, have you taken any consequences from that and tried to understand why that is?
So this is the analysis on the effect of European support is coming from a model, a theoretical model that then is calibrated with our own data, coming from the firm side. So it's coming, but it's coming from a theoretical model with the proper calibration, and it's a part of a project that we anticipated actually in this year report, but it's still going on, doing a more disaggregated analysis. The reading that we have so far, and it's probably, so from the analytical part, the reading that we have so far is really on this distortion to the market that you introduce when the measures are national based. You affect the competition at the European level, and that's what comes out from the model. You affect the competition at the European level. You have a distortion of the market while when you have policy support that affects all firms at the European level, you don't have this distortion effect. And the fact that is stronger, the distortion effect in the mid-tech sector, I personally explain, but it's my bias if you want, I explain on the fact that this is the area in which at the national level, I think more mistakes are done in terms of policy, but that's my own explanation. I think this is an area in which we think much more work has to happen. If I speak instead more on our operational level, think as an institution, I think, again, what we are trying to do more and more as an institution, and I'm thinking also at innovation finance, it's instruments that are available throughout Europe on innovation finance. And part of the story is that you have also a lot of in the specific case of innovation finance, you have a lot of support going on also through the National Promotional Bank, etc. But then you have a dispersion, so discrimination across countries. So if you are firm A and you live in a certain country, so you may have available financial instruments that if you are exactly the same company in another country, so you don't have available. And I think in the European single market, you shouldn't have it. So the fact of having instruments that can be in the design, in the target of firms, at least available all over Europe, I think it's something important for the market itself. I happened to visit a company recently in quite an innovative company in one of the countries in the European Union, a smaller one. They were saying our government doesn't invest that much in startup, scale up, etc. So we cannot have the same level of financing that others have.
So they go to the United States.
So no, they were actually trying to get through us some financing, but actually it makes a difference because the government was not participating in a program, and by not participating in the program, basically it was much harder for them to get the financing. So I think Europe, the more we have a European-wide instrument available all over, the better for the single market is.
All right. So it's time to wrap up. I just want to thank Debora for a fantastic presentation, also exciting and very stimulating Q&A. I have no doubt that Europe faces significant challenges right now, and if it doesn't get its act together, will be certainly further behind compared not only to the United States and China, but also potentially India and other parts of the world. So I think it's time. I have no doubt also that boosting investment is going to be absolutely key for Europe. And in that context, the EIB and institutions like the EIB will be absolutely instrumental to change things for the better in Europe. So we wish you luck, and looking forward to continue working with you and cooperating with you. And with that, I would like to ask you for a big round of applause to Debora. Have a good day.